and good morning to Dr. Ashraf and our colleagues. Today we would like to present Chapter 1, Goals and Governance of Group. I would like to introduce the members of group involved, myself, Naizatul binti Rashidli, Siti Aminah binti Abu Hassan, and lastly, Sarah Amani binti Zakaria. Now I want to share subtopic of this chapter consists of 4. First, corporate investment and financing decisions. Next, financial managing roles and opportunity cost capital. Third, goals of corporation, and lastly is agent problems and corporate governance. To explain a learning outcome. First, maximizing shareholders' wellness. The principal goals of most firms is to maximize shareholder wealth, which increasing the value of company for its owner. Next, balancing stakeholder interests. Such shareholders are curious, firm must also consider other stakeholders such as employee, customer, supplier, and committee. Third, role of corporate governance. Corporate governance related to the system by which companies are direct and controlled, ensuring accountability, ethics, and sustainable growth. Effective governments promote ethics, behavior, and decision making, leading to sustainable growth. I want to introduce finance. Finance is about how individual, business, and organization manage money over time, including raising funding, allocated resources, and handling risk involved in their activities. For corporate finance, focus on financing decision companies make, such as investing and funding projects, and the tools they use to analyze this decision to maximize value. Financing decision of companies aim to define of their interest investment, and their typical involve 3 primary sources of capital: debt financing, equity financing, and return earning. Debt financing is borrowing fund that must be repaid with interest. However, it also introduced obtained to make regular prepayment, which can stain cash flow and may affect credit rate. Equity financing involves raising capital by ensuring share of stock, providing fund without the needs of repayment. It's to ownership and may involve the share profit with investor, which can affect control a decision making with the company. Return earning refer of company profit that can reinvest into the business that distribute as dividend. This reduces capital avoid debt obligation as ownership indicated as this financing stability, which is the amount available in limited of company profitability and assist retention that might lead shareholder because if no allegate that their expected companies also combine their financing method to balance control, risk, and growth objective, aim to optimize their capital structure for long-term success. Investment decision, technical of investment decision. Investment decision is critical of companies aim to allocate capital effectively. And net present value, NPV, calculate the present value of future cash flow sustainable of interest investment. A position, NPV, indicator of profitability project. Interest rate of return, IRR, indicated the discount rate that make it NPV of project zero. If IRR the requirement of rate of return, the project is considered valuable. Payback period, measuring the time need to recover the investment. Short period are referring quick return. Their technical help assist the financial valuable of project. However, investor decision is also influenced by external factor, market condition, economy factor like investing rate, inflation, customer demand are impact project profitability. Industry rate, technically advanced, and customer preference may detect related of certain investment. Regulation, environment, government policy, tax, and regulation can affect the fit and cost of project. Company can raise capital through 2 primary methods: debt financing and equity financing. Debt financing involves borrowing funds that must be repaid with interest. through instruments like bond, bank loan and credit facilities. Bond are long-term debt security issued by investors, offering priority interest payment and principal repayment at maturity. Bank loan are borrowing capital from financing institutions using the fixed repayment schedule and interest rate. Credit facilities are pro-approval line of credit that business can draw up as needed, offering flexibility and of short-term funding at requirement. Equity financing, raising capital by issuing share of stock such as common stock, which shareholder ownership right and potential dividends, return earning and other forms of equity financing. Repaid profit invested into company risk the development of as dividend and several as sources of fund. Several factors influence the company financial decision. The cost of capital encompasses the interest of debt. The expected fund of demand by shareholder is considered low cost opportunity and generate preference, but they come with rate of risk tolerance play a significant role. Companies with a low risk tolerance may avoid excess debt to prevent financial stress. That way, higher risk tolerance may oppose debt more borrowing to influence aggressive growth. The capital structure or mix of debt equity affected financing flexibility and credit. A balanced structure maintains the stability and investor confidence. Additional, a company growth stage impact financial decision. Suspect of requiring equity due to limited access to loan. However, estimated company may use debt to fund exploitation of lower costs. Capital budgeting and financing integrated. Investment decision require capital allocated when financing decision determine how to fund their investment. Company need to assess both of cost of capital and project risk that making this decision. Strategic consideration. The impact of financing lever on profitability, long-term versus short-term financing, stability, corporate government and shareholder interest.
So hey guys, so I will continue with the role of financial management. Before that, I will introduce my name is Siti Aminah. So let's go through with the role of financial manager. So first, financial manager has the treasure and control the financial of company. Next, not just that, financial manager also have to handle cost, financial accounting, tax payment, and the managing information system. And as a financial manager, it must have a responsible for managing the firm's cash, capital, credits, financial planning, and capital expenditure. Last part of the role of financial manager is he or she must build the trust through the transparency and accuracy in every part they doing. So next we go through with the opportunity cost of capital. So this opportunity cost of capital is referred to the rate of return that a company or investor forgoes by investing in a particular project instead of the next best alternative with a similar risk profiles. So in this concept, opportunity cost of capital is a fundamental in capital budgeting, investment analysis, and financial decision making, and it also helps in elevate whether a particular investment is worthwhile compared to alternative. So I also have attached the formula for opportunity cost of capital, which is the opportunity cost of capital is equal to the rate of best foregone investments. Attach an example in this slide. So investor has two options, which is invest in $10,000 in project A, which is expected to have a return 8%, while invest $10,000 in a project B, which is expected to have a return 6%. If the investor chooses a project B, the opportunity cost of the capital is 8%, minus 6% is equal to 2%. So these 2% represents the return of the investor missed out on by not choosing the better performing investments. So actually this the consideration by investor, which is risk adjustments, which the opportunity cost of capital must be compared investment with similar risk levels. So the risk level must be compared with A to A, not A to B. It must be A to A situations. So not just that, the time value of our money is incorporate the concept that money today is worth more than the same amount in the future. So lastly, the consideration should be taken in implicit cost is not a direct expense but an implicit or hidden cost often overlooked. So we'll go with a weak average cost of capitals. In a company, the opportunity cost of capital is often the weak average cost of capital is known as WACC, which represents the minimum return of a company must be earned on its investment to stage-defined or stakeholder, or known as equity holder and a debt holder. So here I attach a WACC formula: E over V times with RE plus D over V times with RD and times a bracket 1 minus DC close bracket. Whereas E equals represent the market value of equity, this represent market value of the debt, and V total firm value, which equity plus debt. So R is represent the cost of equity and RD represent the cost of debts. So TC is a corporate tax rates. So next we will go through with overall for opportunity cost capitals. This which means that reflect the foregone return from the next best investment. It also helped assess whether an investment is financially justified. And lastly, is a crucial in investment appraisal and strategy financial planning. So this is the last part I will cover. So this, what's the goal of a financial managing for corporations? So what our business owner want to achieve? They want to achieve to make more money and add a value for the owner. So the goals tend to fall into two classes. Goals tend to fall. First one is profitability goals and the focus on controlling risk. So we go through the profitability goals. It's a different way to gain and increase the profit from time to time, especially in sales and market share and cost control. And not just that, it will focus on controlling risk to avoid bankrupt and having stability and safety. This is the last part I will cover. So next, I will go with the overview point from stockholder. So when stockholder view this goal have achieved, in a good decision, it will make them to maximize the current value per share of the existing stock. So the
next part is agency problem. Agency problem refers to the possibility conflict of interest arises between the stockholder and management. Conflict of interest arises when managers serve their interests more than company's interest, and to a certain extent may jeopardize the company's interest. Agency costs refer to the conflict of interest between the stockholders and management of a firm. There are two categories of agency costs, which are indirect and direct agency costs. Indirect agency costs are lost opportunities, while direct agency costs comes in two forms. The first form is corporate expenditures that benefit management but costly to the stockholder. For example, company CEO might invest in expensive luxury perks that benefit management but personally do not increase the shareholder value. This creates a conflict because the shareholders want profit and growth, while the manager focuses on personal comfort and reputation. The second form is expenditures that arises from the need to monitor management actions. For example, a manager may reject a high-return investment project because it has a chance of failure or fearing it could make them look bad or lead to job loss. However, shareholders would prefer the company to take the risk because the potential rewards are high. So how to control agency problem? Firstly, board of directors could control through managers who perform well and stay loyal to company goals will be promoted. For example, companies like Unilever and Toyota use performance-based promotions to motivate managers. Promotions act as a long-term incentive. If managers know that working in the best interest of the company leads to career advancement, they will be likely to act responsibly and avoid self-serving decisions that only benefit to themselves. The second, the board of directors could actively monitor to ensure managers act in shareholders' best interest by linking their rewards to specific performance goals. For example, Tesla 2018's plan for Elon Musk only rewarded him if he met tough targets like profit and market value. If he failed, he got nothing. This motivates managers to focus on long-term company success. The last one, government could help prevent agency problems by enforcing regulations that promote transparency and accountability. For example, agencies like SEC in the US require public companies to disclose executives' compensation and explain how it's tied to companies' performance. This discourages excessive pay and ensures that managers are rewarded for actions that benefit shareholders, not just themselves. Corporate governance refers to the framework of rules and practices by which a board of directors ensures accountability, fairness, and transparency in a company's relationship with all stakeholders. Simply put, corporate governance is the framework used to run a company, which is responsibility of the board of directors, a group of elected individuals who represent the interests of shareholders, while CEO is responsible for the day-to-day operations of the company. For effective corporate governance, both board directors and CEO must work hand in hand to drive company forward. The board key duties depend on the unique nature and the needs of company it oversees. With so many issues at stake, robust discussions, timely decision-making, and a healthy board cultures are critical. As such, boards are increasingly become more diverse by appointing members with diverse backgrounds, skills, and experiences. This will encourage multiple perspectives and helps prevent groupthink. Also, a diverse board is likely to represent the interests of all stakeholders, which can improve corporate governance and boost company performance. So, we can conclude that a very good corporate governance is the bedrock of a very healthy organization. It builds trust with investors, and the wider the community, it ensures the long-term success of the company. And also, company also can reach their corporate goals, which can maximize shareholders' value. That's all from us. Thank you.